Welcome to STRAT this week for the week of March 6th. Will Woodall, Mike Rarey. We're going to take you through the February numbers and talk a little bit about what happened in February, why the numbers were so ugly in February, and contrast that with some of the market signals we're seeing that might tell the Fed to perhaps continue hiking. And we've seen a big change in the last month in expectations for hiking. So let's start off with a look back at equities for the month of February.
Yeah, that column furthest to the left there, month to date, represents February. So you see red numbers across the board. Large caps, large value stocks down more than small cap stocks, but equities by and large still holding on to their year-to-date gains. So those very strong returns in June still showing up in that year-to-date column.
And foreign space, much of the same.
Yeah, foreign space, we definitely had a sell-off and a bit of a reversal in emerging markets. Mm-hmm. Emerging markets had a very hot start to the year, and then you see giving up 6.5% here in February.
And how much of that was in relation to the dollar strengthening?
Yeah, a good chunk of that was dollar strength coming back in February after really weakening, definitely to start the year and late last year. So, yeah.
All right, let's look at fixed income across the board, another rough month.
Mm-hmm. Yeah, and you can tell, during February, stocks down, bonds down. Oh my gosh, are we replaying 2022? And no, we're not. Bonds look far more attractive than they did early in 2022, primarily because of, one, what our framework says in terms of economic growth, recession, et cetera, but then also the yields are just so much more attractive as a starting point. Yeah. So just giving back some of their strong gains, really since October, bonds have been performing well.
Yeah, I mean, we've been buying 2-year treasuries at 5%, which is pretty unheard of.
Yeah.
Let's look at alts, same period here.
Alts, so global REITs and commodities, definitely a tough month. Commodities, a really tough start to the year, going from low and rising, which is the best price regime, to now low and falling, which is one of the worst price regimes for commodities. And a lot of the weakness came in the industrial metals complex. And, industrial metals, things like copper, nickel, et cetera, had a hot start to the year on the Chinese reopening. And it was really sort of buy the rumor, sell the fact now that the Chinese Communist Party have come out with their full year economic growth forecast for 2023. And it was, on the low side of things. Mm-hmm. Industrial metals have definitely sold off into that.
Yes.
Yeah.
All right. So we have a new graph. I'm not sure. I think we've shown this once before, but let's look at this chart and looking at economic surprises versus current financial conditions. Mm-hmm. Describe the chart, but more importantly, how does the Fed interpret this information?
Yeah, definitely. So year to date, it's been a good news is bad news type of a situation. Good news was basically good news in January, mm-hmm. and then the market coming to grips with the fact that good news in terms of positive economic surprises. So you see that's the green on this chart here recently, economic data coming in stronger than expected. The biggest positive surprises were the January non-farm payrolls report, way hotter than anybody expected. ISM services PMI rebounding very strongly, and then those retail sales numbers showing resilience in consumer spending. So that was the good news. And how that becomes bad news is the Fed is of the opinion that monetary policy, or the Fed hiking interest rates, slows economic growth, which then results in lower inflation through tightening of financial conditions.
Right.
And so that's the blue line. When that blue line is going down, financial conditions are tightening. When it's going up, financial conditions are loosening. And so what does that mean? Well, this is the Fed's own financial conditions index. This is the Chicago Fed. And what it does is it measures the looseness or tightness of money markets, equity and debt markets, and the banking system. Mm-hmm. So if credit is plentiful versus if credit is scarce, if bond spreads are wide versus if bond spreads are tight, and so on and so forth, and turns it into one number. And what it shows if you're the Fed is, technically speaking, by your own measure, financial conditions are just as tight today as they were when you did your first rate hike in March. And so the market is sort of actively undermining the Fed's ability to slow economic growth and lower inflation, is what that is effectively saying. Through you see the big rebound, loosening of financial conditions since September, October. Mm-hmm. That's when the equity market found its recent bottom. Since then, equities have been rallying. Bond yields found sort of their recent high, and since then, bond yields have been coming down. Credit spreads blew out, and now they've since tightened. And all that sort of undermines the Fed's ability to bring down inflation. And so
we've seen that in our framework.
Exactly. And this is where the good news becomes bad news, because it sets up for potentially another round of hikes and peak Fed funds rate moving it even higher than everybody thought.
And so why the optimism in the financial conditions if this is sort of the reaction the Fed will have?
Right.
Like, how volatile is this figure, and how does it roll over?
Yeah. It's so we know how volatile the markets are, and we know they control financial conditions in reality. The Fed thinks they do, but clearly the market controls the financial conditions. And, if the market were to, let's say, the Fed has the March meeting coming up in a couple weeks, and let's say Jerome Powell comes out there and says everything he would have said in Jackson Hole last August. Well, then the market would sell off, credit spreads would widen, bond yields might rise, and this financial conditions index would come down again, and that's how you would get potentially inflation to come back down and economic growth to slow. So it can be very volatile.
Yeah, I think we have quite a busy week this week of speakers and information coming in, so it could be heading in the other direction quickly. Mm-hmm. Okay, let's update our inflation forecast. There's not a big change here, but I think the news is we're not going to decelerate as quickly as we had originally forecast.
Right. The big news during February was we got the January CPI numbers. And if you look at the month-over-month change from December to January in CPI, and you annualize those, core CPI is running at 5%, which just so happens to be almost right in line with our updated 12-month out forecast for core CPI. Right. And also happens to be nowhere near the 2 to 3% range that the Fed is looking for in terms of making progress. And why, was January CPI a little hotter than expected? Why do our 12-month forecasts, why were they pushed up during the month of February? Because a lot of the economic data surprised to the upside. The labor market is, it looked like coming into January that the labor market was softening as it normally does. Everything was sort of playing out as it normally does in the typical labor cycle. And then you get that January non-farm payrolls report, and it shows there's a big shortage of workers, and that pushes up inflation 12 months out. So this is once again where the good news starts to become bad news. Because now the Fed is not at all happy with this. Anybody who was hoping for a soft landing, that is not what a soft landing looks like.
Yeah, and it translated into quite a change in expectations. And we go to the next chart here. This is basically 1 month move from over 100 basis points on the terminal rate. So take us through this.
For those that don't look at these types of charts all the time, this is huge. This is significant. Well, I guess what is this? We should say what it is first. But first, it is what the Fed funds futures market, so what the market thinks the path of the federal funds rate will be. And this goes all the way out to 2028. So this is very long term. We look at these charts all the time. To give some context here, this was not a very exciting chart, basically since like last October. Everybody basically thought something like the blue line. All right, well, the Fed's going to hike up to something around 5%, give or take 25 basis points, and then they're going to start cutting. Because at that point, we will have either engineered an immaculate disinflation and this beautiful soft landing, and then you can just cut rates, what a luxury, or we will have gone into an economic recession, and then the Fed will be forced to cut rates dramatically. Right. That was the blue line, right? And then in just 1 month, from the end of January to the end of February, we moved from the blue line to the red line. So now it looks like the Fed has to get like somewhere around 5.5% this year. Almost no cuts in this calendar year. Right. Still aggressive cutting in 2024. Right. Which once again is it's one or the other, right? It's either they manage this immaculate disinflation soft landing, right, and they have the luxury of cutting, or there's a recession. But then you'll notice at the end of 2024, when interest rates and the economic cycle and inflation should have, quote unquote, normalized, the market is expecting the Fed to have the Fed funds rate at 4%, which, if that's our new baseline neutral rate of interest, compare that to the prior decade where the baseline neutral rate of interest was 0.
Right.
That is a huge adjustment.
Yeah.
A huge adjustment.
I think that's super important. That's a huge factor as you look longer term, but maybe just, I think, talk about the gap here that is going to really happen over the next year if we do follow this upper path, where we're at 5.5 or potentially higher, and we're staying at such a high rate. What pressure does that put on corporate earnings?
Yeah, exactly. So we think monetary policy, the level matters, and it works with long and variable lags. So if every single projection that anybody at a company is used to is based on 0% neutral rate of interest, and now we adjust that to 4,
right?
That has, it's impossible to say how significant all the knock-on effects of that will be, going from assuming virtually nothing, money is free, to assuming a 4% right. neutral Fed funds rate. Imagine if right now you're in the habit of rolling over high yield debt. Well, just tack on 4%, and then rerun your cost of capital.
Right.
It could be that significant. We'll ultimately see. Yeah. The reality is probably the red line's not right and the blue line's not right, which will be fun. That's why we look at these all the time.
Yeah.
But there's no way to tell how significant the knock-on effects could be.
Yeah, in corporate earnings for Q1 weren't terrible, but they weren't great.
Yeah.
So if we do have a few more quarters where rates stay elevated like this, it's just going to continue to push companies down that road of their costs are going to be growing too fast.
Yeah.
And they're going to have to do something, which should start to impact the labor market.
Right. For sure.
Okay, great. This is a great chart. Let's move on to liquidity, because we did get an update on liquidity.
So when we move from that blue line to the red line, what that means for liquidity is liquidity goes down, and it just stays down. So liquidity, once again, is year-over-year change in the money supply. The January M2 number just came out last week, and it showed negative 1.7% year-over-year. So now we're really starting to sound like a broken record here. This is definitely the fastest slowdown in liquidity in history. This is only the third time ever that the year-over-year change in the money supply has been negative. The prior 2 times were December and November. So this is sort of it. And now if you look at 1 year ago, there are approximately $400 or so billion fewer dollars in the money supply than there were a year ago. So it's sort of the case of the missing $400 billion. There's a theory that money is never destroyed. It's just passed from one hand to another, and someone's income is another person's expenditure, and so on and so forth.
This would say different.
Well, yeah, we're looking for the $400 billion.
Yeah.
What most likely happened is the Fed will look back on this and say, oh, well, this argues that we need to change a definition of what is included in M2 and what isn't. That's what normally happens.
Yeah.
And then they'll backwardly revise the data, and it'll look like it came down to close to 0. But for now, in terms of the market, in terms of everything that's going on, once again, a low liquidity environment is very difficult. It's a very difficult starting point when you think there are fewer dollars today than there were a year ago, yet we want to generate more economic growth with those dollars and drive asset prices higher with those dollars. It just doesn't really add up.
Yeah, and I think for the viewers, again, this is the line of growth that we need to look for. So anytime we're below that, it's not good.
Yeah.
So we're far below it. And we need to see a big rebound in order for it to really support economic growth going forward.
Yeah, sustainable recovery in real economic growth and equity prices.
And how much impact could potentially China have or other countries have on this situation for us?
On our liquidity situation? Yeah. Well, they certainly could help us do more with the same number of dollars. this is U.S. monetary supply, U.S. money supply. So we know there are U.S. dollars outside of the U.S. that we can't measure or track. And, China reopening, Europe avoiding recession, all those things basically mean global economic growth might be a little better. And so it'll look like our dollars are generating more GDP for the same number of dollars. And then also there are dollars outside of the U.S., outside of the U.S. banking system that can still buy U.S. stocks and other assets. So this is, the dog that does the wagging. But yeah.
So I'll ask you another question, because recently Japan Central Bank came out and said we're going to continue to do stimulus. Why are they sort of going in a different direction than we're going?
Yeah, well, they have a much different setup in terms of demographics, economic growth, and inflation. I mean, they've been begging for inflation for decades, and now they're starting to get it. If they were to take our monetary policy stance, they would put themselves into a depression. So it's just not compatible at all. So, if anything, they're a little excited about it. Now, when they get a change of leadership at the Bank of Japan, potentially you could see something like, a move in the direction of where we're headed with monetary policy, although, a drop in the bucket compared to what the Fed has just embarked on in terms of the second fastest rate hike cycle ever. But they're just never gonna catch up. Too much debt, not enough growth, aging population. Just not even close.
All right. So let's just turn our attention to the recession forecast. Give us an update here.
Yeah, the recession forecast during the month of February, we saw it decline slightly. Year to date, it's declined slightly. The overwhelming majority of that decline has come in the nearer term figures. So once again, this blue line is a composite of all of our right now 3-month out, 6-month, 9-month, and 12-month out recession forecasts. And so that really does matter. The right now, there's only a 22.9% chance we're in recession right now. Why is that? Well, because it's almost impossible to be in a recession if we just added 517,000 jobs to the economy. So, and then you see that play out in the 3-month. The 3-month has come down from close to 50% to now, right around 45, 46%. So that's where the movement has been. The 6 to 12 months out remains elevated. That recession that far out is determined by different indicators. It's determined by things like the yield curve. It's determined by things like the Conference Board LEI, new housing starts. All those things are still showing elevated risk of recession, just not right now, more like in 6 to 12 months.
All right. And so we sit here at the beginning of March. What do we expect for March in terms of just market expectations? How are we going to see, GDP estimates for Q1 are still so wide you could drive a truck through them. What should we be expecting to happen in the month of March?
Yeah. So you have a lot of big data points coming out, and, at their extremes, they could go one of two ways. So obviously you have things like non-farm payrolls, retail sales, and you have CPI. Now, what those can show, they can either show, hey, January, February, we're no fluke here. The U.S. economy is far more resilient than we thought. And that would just further this sort of good news is bad news type of a situation. What that's going to mean is, CPI is probably going to be hotter for longer, and that means the Fed's going to have to hike more and, replay of what we just went through in February.
Right.
Or what's going to happen is, the seasonal adjustments, January, February data have huge seasonal adjustments to them. And those are going to start to normalize. And so what those might show is actually January was sort of the odd data out. And we actually were seeing a continuation of slowing in the economic growth. In which case, then you would look at, where the Fed funds rate should be next year. Maybe it comes down a little bit. Earnings projections come down. So it's going to be one of those two things. Either we normalize these seasonal adjustments, and it's, actually the economy was slowing this whole time, just as it looked, or it's going to be more good news as bad news. So
it should be an interesting month throughout this whole year. This would probably be the key month where we'll know sort of how things are going to play themselves out.
Yeah, be very exciting.
Awesome. Well, thanks for joining us. And if you have any questions, as always, reach out to us. And we appreciate you watching. And we'll be back here next week with another update.